which is really the mechanism at the core of all economies. It's the money creation mechanism. Where does money come from? And it's funny because when you study economics, as I've done, I mean, in any discipline, whether it's chemistry or physics or whatever, you know, you study it at the top universities, you expect to become an expert in the important stuff in your discipline. But when you study economics, they don't really teach you about the money creation process and the monetary mechanism, because the leading economic theories and models, as you know, I mean, the highbrow ones, they don't even have any money whatsoever in their model. It's an abstracted theoretical economy where essentially people exchange things via barter. That's what they assume, because money doesn't matter. So we might as well take it out of the equation. It just confuses things. I mean, there's the famous book by David Romer. In fact, I did a survey. What's in the UK at British universities, what is the most widely used master's level macroeconomics textbook? And it was David Romer. You know, it's his key book on macroeconomics and growth. And then on page 3, it says, you know, essentially for more than half in the book, the models and theories don't include money because this would only confuse matters. So that was the state of affairs.
We heard from Jay Powell just a few days ago that it was no longer an appropriate part. It was no longer an appropriate mechanism for central banks to look at the money supply. And that is the orthodoxy.
Yeah, yes, indeed. But really, it's surprising that he says this now at this late stage, because certainly since 2008, a lot of people have realized that, oh, you know, we neglected the monetary mechanism, and really we can't just exclude money. We have to understand how it works and where money comes from. And that was also my original puzzle when I was Shimomura Fellow in Tokyo in 1991, and I had this task to my research topic on the basis of which I became the first Shimomura Fellow was to figure out Japanese capital flows that were buying up the world, as you started out mentioning, you know, Japanese money buying Pebbles Beach golf course, Rockefeller Center, Columbia Pictures, whatever, in Australia, in Hawaii, and in the UK, they were buying up companies, real estate, whatever, you name it. And it was just so much money that no standard economic model could explain it. All the world's experts were saying, we don't know, there is no answer. Somebody told me, oh, there's you know, famous US economist, Jeffrey Sachs. He was recently in Tokyo at MITI, the Ministry of Industry and Trade, with his, I think, former PhD student Peter Boone, and they've written a paper on just this topic. Richard, you should go and speak to MITI, they will have the paper. And I went there, met various bureaucrats, and they told me, yes, yeah, Professor Sachs and Peter Boone, they were here. Oh, yes, we have their discussion paper, which they presented. And it was, because my fundamental idea was it's clearly linked to these crazy asset prices, land prices, where the Imperial Palace Garden had, as you said, the same value as the entire state of California, including Los Angeles, San Francisco, you name it. Crazy. And so that there had to be a link. But what precisely was the link? There was the paper, Jeffrey Sachs, Peter Boone. I was delighted because, you know, I barely finished my first degree at the LSE. By the end of it, I was very disappointed to find there is no link. That was their conclusion. There is no link. Why? The argument was, well, okay, you've got totally overpriced Japanese real estate to the extent that it makes sense for Japanese landowners to just sell a tiny plot of land and buy a few big chunks of California. Why not? You know, just for diversification purpose alone would make sense. And that would give you the mechanism. But they were arguing, well, hang on, even if you did that, which seems perfectly rational, this wouldn't affect capital outflows or the whole, you know, monetary situation. Why? Because if you own the land and you want to cash in, you've got to sell it. And who's buying it? And foreigners were not buying Japanese land because it was outlandishly expensive. So it was only other Japanese who were buying the land. And therefore, it's just money moving from Japanese owner A to Japanese landowner B. and therefore plus minus zero international impact. There shouldn't be any international impact, which was a logical argument. But Richard Koo at the time, he was known as a capital flow expert. And I told him about my job, my task. I need to find out what is this link between the property market and capital flows, or otherwise what explains these capital flows. And he told me, look, Richard, forget it. You won't be able to solve this one. It's too complicated. Nobody has a model that works. So, but it didn't give up.
That was a challenge.
Yeah, it certainly was a challenge. I mean, all the experts were saying, there is no link. Doesn't, do something else. You won't be able to crack that nut. So, but the conclusion is that I did find out. It's a very simple insight, which at the same time answered so many other questions as well. It goes straight to this money creation process. And the answer is that no, the landowners that want to cash in and diversify and invest abroad, they don't need to sell their land. They just use it as collateral to borrow money from a bank. But now comes the next step. What happens when you borrow money from a bank? What happens then? All the leading finance journals and most textbooks will tell you, well, banks are financial intermediaries. They gather deposits. They do their analysis on credit, evaluation and credit rating and all sorts, and then they use some of those deposits and lend it out. So they're financial intermediaries. They're just in between the depositors and the final use of the money. But it's not true. But the conclusion is this is not actually what happens when a bank gives out a loan. Banks are not financial intermediaries. I could show this with data. But empirically, I proved this only much later. This was published only in 2014, where I did a separate empirical test. This is using German banking data, because really, this financial intermediation theory is only one of 3 theories of banking. And it's extraordinary. I mean, banking has been around for 5,000 years. You go back to ancient Babylonia, and there were essentially modern banks. There was a credit economy. There was interest being charged. There were collateralized loans, uncollateralized loans, cashless transactions. It was a proper banking system, because essentially banking is accounting, and they kept good records, and we have them in the British Museum, thousands and thousands of clay tablets, right, in cuneiform, where they noted, and they're mostly accounting records and banking records. So banking is ancient, yet until recently, there's been a debate, still an ongoing debate, a controversial debate about how banks actually work. And there's these 3 theories of banking. Now, the one that I described is the dominant one, the conventional one that's in all the textbooks and finance Journal of Finance, and so on, Journal of Money, Credit, and Banking. They think banks are financial intermediaries. This is not based on empirical evidence, by the way. Now, there's a second theory, and that's the older one. And some people remember, because that used to be taught in the textbooks, also in economics, namely the fractional reserve theory of banking, which says that, a bank always has to put a percentage of their deposits with the central bank, the fractional reserve, and let's say if it's 1%, the bank gets a new deposit of $100. It will put $1 with the central bank and lend out 99, but the 99 will then become some other bank's new deposit when you use it. And that bank will then put 1% aside, give it to the central bank as a reserve, and lend out 99% of that, 98 point, and so on. So the whole thing continues. That will then become some other bank's deposit. Each time the amount gets smaller, and it's a geometric progression, and mathematically, and you can calculate the total. And with a 1% reserve requirement, the 100 initial deposit become 10,000 in aggregate in total deposits. The central bank has 100 as their total reserves from all the banks, these small amounts, and total new lending in the banking system is 9,900. That's the fractional reserve theory. It's sort of slightly complicated, but sort of also, I mean, there's a certain logic to it. Now that's not any more popular, as you may know, you may have noticed. I mean, nowadays they don't talk about this. They talk only about this financial intermediation theory. Banks are like non-banks. There's no difference. Now there's a third theory, and that one is the oldest. That one was popular from essentially, well, until roughly the 1920s, 1930s. That's when the fractional reserve theory started to become dominant. Until the 60s, then we had the financial intermediation theory. And this oldest theory is the credit creation theory of banking. Now that's the most surprising one. And that one says banks are not financial intermediaries. They do not intermediate. They're actually creators of money. And when a bank gives out a loan, this is newly created money that's added to the money supply, but not like in the fractional reserve story in some kind of indirect collective fashion where you can't kind of grasp where's the money creation. Oh, it's just in the system. It happens in sequence. No, the credit creation theory says, no, each individual bank creates new money when it gives out a new loan. So these three theories, they differ in terms of the question of when a bank lends money, where does the money come from?